For generations, the playbook for building wealth was simple: buy stocks, own real estate, and let time do the work. That playbook made millionaires. It built empires from patient, consistent growth. But what if that playbook is getting a little outdated? What if the very definition of an asset is being rewritten right before our eyes? A new digital contender has entered the ring. It doesn't trade on Wall Street, it doesn't have a CEO, and it promises life changing returns in months, not decades. But with that promise comes gut wrenching risk that can wipe you out just as fast. So, in the battle for your financial future, proven tradition, or explosive revolution, where should you place your bet? It's a tough question, but we're going to help you figure it out. In this video, we'll break down the future of wealth, compare the old guard with the new challenger, and give you a clear framework to decide what's right for you. We're going to give you the information you need to make a smart decision. If you're ready to finally understand this financial showdown, make sure to hit that like button and subscribe for more deep dives that empower your financial journey. Now, let's get into it. Before we can understand the future, we have to respect the past. For over a century, the main engine of wealth creation for everyday people has been the stock market. So, what exactly are traditional investments? At their core, they're established, regulated assets that have decades, sometimes even centuries, of performance data. The most common examples are stocks, bonds, and real estate. Let's zero in on stocks, the cornerstone for most people. When you buy a stock, you're not just buying a ticker symbol on a screen. You're buying a tiny piece of a real world company. You become a part owner of its buildings, its patents, its brand, and most importantly, its future profits. The value of your stock is directly tied to how that company performs, its sales, its innovations, and its place in the wider economy. This is the fundamental problem traditional investing solves. It gives you a way to share in the growth of the overall economy. As companies succeed and the economy expands, the value of your ownership grows with it. Historically, this has been an incredibly reliable way to build wealth. The S&P 500, an index of 500 of the largest US companies, has delivered an average annual return of about 10% over the very long run. Now, it's crucial to know that this is a long-term average. Returns vary wildly year to year and include major downturns, but the overall trend has been remarkably consistent. This growth is often turbocharged by two powerful forces. The first is dividends. Many established companies, so-called blue chip stocks, share a slice of their profits with shareholders through regular dividend payments. It's a stream of income you get just for being an owner. The second force is compounding. By reinvesting those dividends, you start earning returns not just on your initial investment, but on your earnings too. It creates a snowball effect that, over decades, can turn a modest amount into a serious nest egg. Think of it like planting a tree. You start with a small seed, your initial investment. Over time, it grows and eventually bears fruit, your dividends. If you plant that fruit, you get more trees, which bear even more fruit. That's compounding. The earlier you start, the more powerful it gets. Beyond growth, the traditional system is built on a foundation of regulation and investor protection. Markets are overseen by government bodies like the Securities and Exchange Commission, SEC, in the United States. These agencies enforce rules that require companies to be transparent and publish audited financial statements. Stock exchanges have fixed trading hours, which provide structure, though sharp price moves can still happen in pre-market and after-hours trading. If your brokerage firm fails, your assets are often protected up to a certain limit. This whole setup is designed to create a relatively stable environment for investors, rewarding patience over frantic emotional decisions. But, and this is a big but, the traditional path isn't perfect. Its greatest strength, stability, is also what some see as its biggest weakness. The growth is slow. A 10% average annual return is fantastic over 40 years, but it won't make you a millionaire overnight. For younger investors or anyone feeling left behind, waiting decades can feel like a lifetime. Plus, traditional markets are vulnerable to big picture risks like recessions, inflation, and global events. While the market tends to recover, watching your portfolio drop 20% or 30% during a downturn is a painful experience. You're also at the mercy of company decisions and market whims, with very little personal control. And finally, accessing these markets often involves brokers, fees, and limited trading hours, which can feel clunky in our 24/7 digital world. So, the old solution offers a proven, regulated, and relatively stable path to wealth, but it's slow, requires patience, and is subject to forces beyond your control. This has left the door wide open for a new kind of asset that plays by a totally different set of rules. Now, let's turn to the challenger. Cryptocurrency. If traditional investments are like well tended gardens, crypto is the untamed digital wilderness, unpredictable and dangerous, but promising incredible discoveries. So, what is crypto? Unlike a stock, when you buy a cryptocurrency like Bitcoin or Ethereum, you're not buying a piece of a company. There are no earnings reports, no CEOs, and no dividends. Instead, you're buying a digital asset that lives on a technology called the blockchain. Simply put, a blockchain is a decentralized, distributed digital ledger. Decentralized means no single entity, no bank, no government controls it. Distributed means that ledger is copied across thousands of computers worldwide. This design makes crypto transactions incredibly secure and transparent. Cryptocurrencies were built to solve a different problem than stocks. They came from a desire to transact and store value without big financial middlemen. This gives them some unique features. First, many cryptocurrencies like Bitcoin have a fixed supply. There will only ever be 21 million Bitcoin, a feature known as digital scarcity. This has led some to call it digital gold, a potential hedge against the devaluation of traditional money. Second, crypto markets never close. They run 24/7, 365 days a year, all over the world. You can trade anytime, anywhere, often with just a few clicks. This constant, borderless access is a huge magnet for a digitally native generation. But the single biggest reason crypto has grabbed the world's attention is its potential for mind blowing returns. While the stock market might give you 10% in a good year, it's not unusual to see cryptos surge by hundreds or even thousands of percent in a much shorter time. Since its creation, Bitcoin has massively outperformed the S&P 500, but it's critical to understand this wasn't a smooth ride. It included terrifying crashes and long stretches of underperformance. This potential for explosive gains is what fuels the fear of missing out, or FOMO, that pulls so many new investors in. The but here is gigantic, and it's the other side of that high return coin: gut wrenching volatility and extreme risk. The same forces that send prices soaring can also make them crash with shocking speed. A 5% drop in a single day for Bitcoin is a common occurrence. For context, a drop of that size in the S&P 500 is much rarer and usually makes front page news. It's a market where fortunes can be made and lost in hours, driven by sentiment, regulatory news, and social media hype. This is not for the faint of heart. This volatility points to deeper risks. The crypto space is still the wild west of finance. Regulation is a moving target and differs wildly from country to country. A sudden regulatory crackdown in a major economy can vaporize prices. Then there's the risk of hacks, scams, and fraud. In crypto, you are often your own bank, so securing your assets is entirely on you. Billions of dollars have been lost to exchange hacks and clever scams. Unlike with a bank, there's usually no one to call to reverse a bad transaction and no government fund to bail you out. If you lose your private keys, the password to your crypto wallet, your money could be gone forever. Analysts estimate that roughly 15 to 20% of all Bitcoin is already permanently lost this way. So the new solution offers the shot at incredibly high returns and a hedge against the old system, but it comes with monumental risks: insane volatility, regulatory uncertainty, and the constant threat of theft with little to no recourse. It's a high stakes game of risk and reward. All right, we've met the contenders. Now let's put them in the ring side by side and compare them on four key factors: volatility, risk, regulation, and future potential. Volatility. First, volatility, how much an asset's price swings. In this category, it's no contest. Cryptocurrencies are wildly more volatile than stocks. Think of it like this: the stock market is a commercial airliner. It hits turbulence, sometimes bad turbulence, but over time it follows a relatively stable flight path. Crypto is a rocket. It can hit incredible heights at unbelievable speed, but it's also far more likely to experience a catastrophic failure. During a major downturn, the S&P 500 might fall 20 to 30% over several months. In crypto, it's common for an asset to lose 50 to 80% of its value in weeks or even days. We've seen it happen again and again. On the flip side, a stock gaining 100% in a year is a home run. Some cryptos can do that in a month. This extreme volatility is crypto's biggest draw and its biggest danger. Risk. This leads us right into risk. Both stocks and crypto have risk, but the kinds of risks are totally different. With traditional investments, your main worry is market risk, the chance the whole market declines due to a recession or a financial crisis. You can lose money, but the risk of a diversified portfolio of major stocks going to zero is practically non-existent. The risks in crypto are far more numerous. On top of market risk, you have Regulatory risk. Governments are still figuring crypto out. A surprise ban or harsh new rule in a major country could crash prices overnight. Technological risk. The space is full of coding risks. A bug in a smart contract can lead to millions of dollars being stolen from a project. Security and custody risk. This is a huge one. If you hold your own crypto, you are 100% responsible for its safety. Phishing scams and fraud are a multi-billion-dollar industry. If you make a mistake, your investment could be gone forever. And if you leave your crypto on an exchange, that exchange could get hacked or go bankrupt. Bottom line, stocks are safer for stability. Crypto is a high risk, high reward bet. The system around traditional finance is built to protect you. In crypto, you're often on your own. Regulation, next, regulation. This is a battle between an established system and a new frontier. The stock market is one of the most heavily regulated financial arenas in the world. Decades of laws are in place to ensure fairness, protect investors, and demand transparency. You know the rules of the game. Crypto, by comparison, is a regulatory patchwork. That's changing, though. We are now seeing a global push for clearer rules. The European Union has started implementing its MiCA framework, which was finalized before 2025, and other regions are developing their own rules. This growing clarity is a big reason why more big money investors are getting involved. However, a lot of uncertainty remains. The legal status of many cryptos is still debated. Are they commodities, securities, or something else? This lack of a consistent global answer means the rules can change fast, adding another layer of risk. For now, stocks offer a far more predictable and protected environment. Future potential. Finally, let's look at the future. Where are these assets headed? The future for traditional investments is likely one of continued steady growth, tracking the global economy. But a fascinating trend is emerging: the tokenization of real-world assets. Imagine stocks, bonds, and real estate being represented as digital tokens on a blockchain. BlackRock's CEO, Larry Fink, has said this is the next evolution for markets. This could make traditional markets more efficient and accessible, borrowing some of the best ideas from crypto. The future of cryptocurrency is arguably even more transformative, but also more uncertain. Big institutions are no longer asking if they should get involved, but how fast. The launch of spot Bitcoin ETFs in major markets like the US has been a game changer, providing a regulated and familiar way to get exposure. However, access remains limited in some parts of the world. Big financial players like BlackRock and Morgan Stanley are deepening their involvement, and while still a niche practice, a small but growing number of corporate treasuries are holding Bitcoin as a reserve asset. Looking ahead, this convergence is set to accelerate. We'll likely see clearer regulations in major economies, potentially unlocking even more institutional money. The technology itself is getting faster and cheaper. Crypto is slowly evolving from just a speculative asset into the foundation for a new open financial system. But this doesn't mean crypto will replace traditional finance. The future is probably a hybrid, where these two systems become more and more interconnected. After all that, what's the verdict? Crypto or traditional investments? The truth is, this isn't a fight with a single winner. Asking crypto or stocks is the wrong question. The right question is, how do these tools fit into my financial goals? The best strategy isn't about choosing sides. It's about building a diversified portfolio that works for you. Let's recap. Traditional investments, like stocks, are your foundation. They're for stability and proven long-term growth. They represent ownership in the real economy and are backed by a solid regulatory system. They are the slow and steady part of your portfolio, perfect for core savings and for those who don't have a huge appetite for risk. Cryptocurrency is the high-growth, high-risk satellite in your financial orbit. It's a bet on groundbreaking technology and offers a shot at returns you just can't find in traditional markets. But it comes with extreme volatility and unique risks you have to be ready for. It is, by definition, a speculative asset. So, how do you put this into practice? Many crypto-friendly financial experts suggest a hybrid approach as a common rule of thumb. The vast majority of your portfolio, say 80% to 95%, could remain in traditional diversified assets like stocks and bonds. This is your stable base. Then, if you have a high risk tolerance and a long time to invest, you might consider allocating a small percentage, typically just 1% to 5%, to major cryptocurrencies like Bitcoin and Ethereum. This amount is small enough that if it goes to zero, it won't wreck your financial plan. But if crypto continues its explosive growth, that small slice could have a real impact on your overall wealth. Ultimately, you are the architect of your financial future. The goal here isn't to give you financial advice, but to give you a framework for thinking. Don't get swept up in FOMO and don't be paralyzed by fear. Instead, do your own research, understand your personal risk tolerance, and make smart, deliberate decisions. The future of wealth isn't about choosing between the old world and the new, it's about intelligently combining them to build a stronger, more resilient portfolio. What's your strategy? Are you team stocks, team crypto, or a mix of both? Let us know in the comments below. We read every single one. Thanks for watching, and we'll see you in the next one.